Hello everybody, the topic of this section is sensitivity analysis using spreadsheets. The objective of this section is to study how to calculate a break-even volume. Firstly, let's see what's the sensitivity analysis. Sensitivity analysis in capital budgeting consists of testing whether the project will still be worthwhile, even if some of the underlying variables turn out to be different from our assumptions. Let's review the example PC1000 project to study the sensitivity analysis. This table lays out the estimation of the net cash flows for the PC1000 project in a spreadsheet format. The assumptions are cost of capital is 15%. Unit sales in year 1 is 4,000. Sales growth rate is 0%, and the price of each unit is $5,000. The contents, sales revenue to net profit are forecasts of the project's income statements over the next 7 years. Note that the sales revenue is equal to the unit sales 4,000 multiply the price of each unit, $5,000, and is $20 million. In former section, we have studied that the cash flow is equal to the net income plus non-cash expenses. In this project, the net income is the net profit, and the non-cash expenses are the depreciation. So, adding the net profit and the depreciation in this table, the operating cash flows of each year are forecasted and given below the net profit. The content working capital contains the forecast of the working capital required each year, and the next content calculates the additional cash invested in working capital during that year. The content investment in plant and equipment contains the forecast of new investment in plant and equipment in each year. The sum of change in working capital and investment in plant and equipment leads to the investment cash flows. The last one, net cash flow, is equal to the operating cash flow plus the corresponding investment cash flow. Applying the formula of NPV for projects to the net cash flows, the NPV of this project is obtained as $1,235,607. This NPV is calculated under the sales volume 4,000. What if the sales volume changes? Considering different sales volume per year, this table presents the net cash flow from operations and the NPV of this project. Note that there is only one changeable content, sales volume, and the other assumptions are fixed. As the sales volume increases, the NPV also increases. This table shows the sensitivity of the project's NPV to assume the sales volume. Besides, when the sales volume is 3,604 units per year, the NPV of this project becomes 0. This sales volume is defined as a break-even point. So, the break-even point is the sales volume where the NPV of the project would be 0. This means the point of indifference between accepting and rejecting the project. How to calculate the break-even point? First, suppose that the cash flow from the operation is an unknown parameter A, and apply the formula of the NPV for projects to get the specific formula for this PC1000 project. Then, set the NPV of this project as 0. The cash flow from operations is obtained as $1,003,009. Next, The cash flow from the operations can be computed from the formula of cash flow, net income plus non-cash expenses. Here, the net income is equivalent to the net profit, and the non-cash expenses are the depreciation. Suppose that the sales volume is Q units per year. So, in this project, the sales are equal to the price $5,000 multiply the sales volume Q. The total variable costs are equal to the variable costs per unit $3,750 multiply the sales volume Q. In further, net profit is equal to the sales 5,000 multiply Q minus the total variable costs 3,750 multiply Q minus the cash fixed costs 3.1 million and minus the depreciation 0.4 million, altogether to multiply 1 minus the tax rate 40%. So the sum of net profit and the depreciation is equal to the net cash flow from operations, $1,003,009. Finally, solving this equation, the break-even level of sales volume Q is 3,604 units per year. Consider this example for different cost of capital. What would be the break-even volume for the PC1000 project if the cost of capital is 25% per year instead of 15% per year? Apply the formula of the NPV for projects again. We can rewrite the NPV formula for this PC1000 project under the cost of capital 25%. Setting this NPV formula as 0 and solving this equation, the cash flow from operations can be obtained. Set this cash flow from operations equal to the net profit plus depreciation, and express it as an equation about the sales volume Q. Solving this equation, the break-even volume Q is obtained as 4,181. In summary, we have studied the spreadsheet analysis and the sensitivity analysis through an example called PC1000 project. We also studied the calculation of break-even point where two formulas are used mainly, the formula of NPV for projects and the formula for cash flow. That's all about this section. Bye.